Welcome and happy November, everyone. I'm Valerie Leonard, founder and CEO of EverThrive Financial Group. And believe it or not, we're just a few short weeks away from the start of a new year. And so today, I just thought I'd share some things with you that investors need to know this month as we head into the 2026 calendar year. We've got some meaty stuff to talk about today, including what you need to know about a possible market correction. We're going to look at a number of important economic changes, hot off the press updates on inflation, and some detail on the bond market. So be sure to watch to the very end because I'm going to be covering how to look beyond the noise as you prepare for what the market might do in 2026. First, I've mentioned in the past few videos that a normal market correction is possibly ahead of us. So let's talk about why that may not be such a bad thing. So far this year, if you look at the market since January 1st, markets are in positive territory, even with a bit of a pullback that we have experienced in recent days. This chart shows the past 20 years of performance from the S&P 500 through today, November 18th. And here you can see the growth from the bottom of the market in the month of April. And that's going to be on the far right-hand side of the chart. And you're going to see what it looks like through today. All right. And what you'll notice is that's a pretty steep incline, even with that slight downturn that you see in the tippy top right-hand corner of the chart. So as of close of business yesterday, November 17th, the S&P 500 had gained 13.3% so far year to date. And as most of you know, stock market corrections are normal. We technically define a stock market correction as a drop of 10% from recent market highs. And corrections can definitely scare investors. They can trigger concerns about bigger drops to come. And so we're going to talk more about that toward the end of this video. But right now, I don't believe that any possible correction that we might see in the coming weeks and months ahead really signals any gloom and doom ahead. I think it's likely just going to be a typical part of a normal stock market cycle. Plus, during periods of high growth, like what we've seen so far this year, stock market and stock valuations can get overinflated. And so a correction often can help reset those valuations and sometimes even provide the opportunity for investors to buy stocks at a lower price. So that's not necessarily a bad thing when we get a correction. You can see here on the left-hand side of the screen the year-to-date performance from a sector perspective. And what you'll notice is communications, technology, and basic materials, which are circled here, have been leading the charge from a performance perspective so far since January 1st. When we look at the broader economy, what's really important for investors to know is that we're expecting December to potentially be a rocky month from both a growth and an inflation perspective. And we're also expecting to get negative data for fourth quarter, primarily due to the government shutdown. Headline news really might look scary in the first quarter, but what we know is that from a historical reference point, once we see a government shutdown end, that next quarter historically is typically a good one because we see pent-up government spending unleashed on the economy, and that that economy often plays catch up. So we're going to be watching things like inflation. We're going to be watching the jobs market. We're going to be watching consumer confidence closely, all in the months to come. But don't be alarmed if headline news seems a bit dismal. We are expecting some bumps along the way, and I don't believe those bumps are going to be anything more than just noise based off of the information that we have in front of us today. Beyond that, I do believe that the Fed will likely remain dovish, which just basically means interest rates should remain relatively low versus where they've been. And we're also starting to see the US dollar strengthen again. So just know that I'm expecting the first half of next year to potentially be a good one, and we're setting up for that in our client portfolios. All right, now on to tariffs. In September of this year, Yale Budget Lab produced some calculations that indicated that the effective tariffs were costing U.S. consumers about $2,300 a household. And you can see that in this chart. You can see the changes in the average effective tariff rate since the beginning of this year. Since we last met here on YouTube, we saw President Trump meet with Chinese President Xi Jinping, and China agreed to pause export controls on rare earths. That's a critical component in technology, right? So with this change, and also some other changes to tariff policies, Yale Budget Lab has revised their estimates to indicate that U.S. households will be hit by roughly now only $1,800 a year due to the impact of tariffs. So even with this change, we still know that the effective tariff rate has had the highest impact on consumers since 1935. So obviously that's why we're watching consumer confidence pretty closely. I've mentioned in past videos that the Fed has been really in a tricky place when it comes to balancing inflation and also labor market reports. And this has led to impacts on the bond market. So there's a few things that I want to remind you about as it relates to the bond market. First of all, is that bond prices typically fluctuate in the opposite direction of interest rates. So what happens is when interest rates go down, the prices of bonds typically go higher. And the second thing to know is that inflation can be stubborn at times, right? And what we see when inflation is stubborn is that rates will likely trend upward. If growth slows or if risks increase, interest rates may fall because risks are higher in that case. And then the third thing to know about bonds is that a declining bond yield can also reflect weaker economic growth, or it can reflect higher inflation expectations. All right. So these are things that we're watching closely, that we think about when we build portfolios. All right, so what does this all mean for investors like yourself? Well, what we're seeing now is that a yield curve steepening, which is an expectation that short-term treasury bond yields will fall while longer maturity bond yields stay high, that trend is happening and it's likely to continue into 2026. So a key takeaway for you as an investor is to consider really what your time horizon is when you're investing. And you want to always talk with a qualified financial advisor to discuss your specific situation if you're trying to navigate either the stock or the bond market. All right, so moving into 2026, here are some final thoughts for you. We've been seeing stagflation for a little while now, and I believe that we are headed into what I refer to as a Goldilocks economy, meaning things are just right. Growth is steady, but moderate enough to keep inflation at bay, which allows a market-friendly monetary policy. All right, that allows interest rates to stay a little bit lower. And all of this generally leads to better consumer confidence. So while we may hit a rough December and the turmoil of a potential correction may feel a little bit scary, don't get caught up in the headlines about a market drop. Don't be overly concerned about the economy right now. The data that's in front of us says that we're still in a pretty good place. And while I will always do my best to prepare for both better than expected outcomes and also worse than expected market changes, I'm currently preparing for a potentially favorable first half of 2026. On that note, thank you so much for joining us today and for subscribing to our YouTube channel. And I look forward to seeing you here again next month.